Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day, which comes from Alex from Claremont, California. Alan, do you stay invested in bear markets? And if you do, what do you do differently? Well, Alex, that's a question I can spend an entire seminar on, but I'm happy to give you an overview as to the many different strategies you could use in bear market environments. I've listed them on the screen that you could see in front of you now, but let's briefly go through each one of them so you can get a feel that there is a lot of control even in these down markets. The main one that I use is selling in-the-money strikes. When you sell an in-the-money strike, there's an intrinsic value component to the option premium in addition to the time value. For example, if you bought a stock at $32 and sold the $30 in-the-money call for $3, of that $3, $1 or a 3% initial profit is time value. The remaining $2 is intrinsic value. That intrinsic value will give you protection of the 3% time value. So in this hypothetical, you will have a 6.3% protection of that 3% initial profit. Another thing you could do is to purchase protective puts. This is called the collar strategy. An example would be if you bought a stock for $48 and sold the out-of-the-money $50 call. In addition to that, you would also buy a $45 put as protection. So for example, if you got a $2 credit for selling the call and a $1 debit for purchasing the put, your total would be a $1 profit on that particular position, and now you'd be protected from 45 and less for catastrophic share depreciation should that occur. Of course, your profits are limited because of the put debit. Another thing we could do is we could sell cash secured puts instead of writing covered calls. In this case, we sell a put, and let's say if a stock is trading at 30, instead of buying the stock for 30 and selling the 30 call, we just sell the $30 put. If we received a $1.50 premium in this hypothetical, and the option is exercised and the shares put to us for 30, because we received a $1.50 premium for selling the put, we've actually purchased the stock at a discounted cost basis of $28.50. We can then sell the covered call. Another thing we could do is we could use inverse exchange traded funds as our underlying equity. These inverse ETFs benefit when the market declines, and many of them have options. For example, the PSQ ETF is the inverse for the NASDAQ 100 QQQ. Also, we could use low beta stocks. On the screenshot in front of you, you could see the column on the premium report that we upload for our premium members each week, giving beta information. The thing we need to understand is that low beta stocks tend to outperform in bear markets. Of course, management techniques are always important. We need to use our 20%, 10% guideline, which dictates when to buy back the option. We would have a tendency to roll down if the price of the stock is declining, and sometimes even unwinding our position in total if that dictates. So exit strategy execution is very important, as I always stress in all of my educational material. So that gives you a brief overview as to the many different things we could do in bear market environments. For a lot more detailed information, visit the store on my website, the link I've shown on the screenshot in front of you. So Alec, thanks so much for asking that very, very important question. Thanks to all of our viewers from all over the world for watching this video. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.